global financial crisis. Interesting in that it was the deepest recession post-World War II history prior to this most recent one, at about 5% decline. It took a long time, 2 years, to find the bottom, and a very long and very steady expansionary period. In fact, if many might recall, at the end of 2019 and very early 2020, many pundits were suggesting that we were supposed to have a recession merely because this expansion had gone on for so long, and so it was time due for a new recession. And looking around for reasons why it might happen, I'm almost certain, maybe even certain, that the reason that actually caused it, a pandemic, was not on anybody's minds in March of 2020. That said, the March 2020 recession is hallmarked by obviously the most significant decline, a 10% decline in overall GDP, largely because we basically shut down most of the service sector of our economy, which is a very large part of it. And this rivals the Great Depression. But what's very different from the Great Depression here is that it moved so quickly. In fact, it wasn't even quarters, it was only months before we started to reopen, and we regained more than half, about 2/3 of what was lost in very, very short order. That said, then it took some time to further recover and move slowly along. But at this point, merely 3 years from the beginning of this cycle, we're at almost 105% of pre-pandemic level, which is a significant increase. In fact, only a few other expansions have expanded so quickly. And that is largely driven to a lot of what I'll talk about in a second with regard to how we've grown so quickly and that's what's primarily causing much of the inflationary challenges. Is we're growing at a much faster rate than basically our supply chains and our labor markets can fundamentally support, and hence inflation is showing up in the marketplace. But a very impressive recovery, better and larger recoveries than many other Western economies out there today in terms of how well we've bounced back. So very, very strong. Looking at the labor market in exactly the same way, depth and duration again, you can see here that the pandemic drove a humongous wedge, a 14% decline in the total amount of size of the labor market. That's largely because we shut down the service sector, which, as we'll talk about for the next few slides, is predominantly a labor-based sector, and so lots of people lost their jobs. The good news is we very quickly brought about half of them back and have subsequently been working hard to recover. We've just very recently, with the millions upon millions of jobs that we've created over the last year and a half, gotten back above the pre-pandemic level. Now, truth is, probably we would be beyond pre-pandemic level if over the last 3 years if we hadn't had the pandemic, but we're well on our way towards sort of getting back towards trend. And that's also largely driven by a lot of the consumption and the demand consumption in our economy today. So where does that leave us, and what is it that's going on in our economy today? So we're going to break it down into 3 primary categories within consumer spending. Consumer spending is about 70% of the overall economy, and that 70% can be split into these 3 basic categories. Durable goods, the orange line, those are things that are intended to last more than 5 years: cars, major appliances, houses, things like that. Non-durable goods, those are all of the other things that aren't services that you buy. So that's groceries, is a very short term, very undurable good. So groceries that you buy, soap and shampoo and home goods, all of the stuff, the clothing, all the things that we buy outside of those long durable things that aren't sort of delivered as a service by a human. You can see that all 3 sectors at the beginning of the pandemic contracted significantly. In fact, durable goods and services by 20%. Of course, the service sector was because we weren't allowed or were too afraid to go out and experience service-based economic goods. But the durable goods, why buy a car when there is so much uncertainty? So there was a big sort of shock of, well, there's so much uncertainty, I'm going to curtail my spending. Interestingly, non-durable goods didn't actually, they actually went up a little bit, but then eventually dipped down, but not nearly by as much. And that's largely because there's a lot of non-discretionary spending in that non-durable good category, like groceries, right? Then we all realized, well, it wasn't going to be so bad, at least for those who could work from home. and we started to get out and spend, particularly on durable and non-durable goods, and we did it largely online. So you had this explosion in the e-commerce sector with Amazon and online purchases, and a lot of durable good purchases actually around sort of improving the home experience, improving the kitchen, buying the home entertainment system for the movies because we can't go to movie theaters. All of that sort of spending really accelerated good and non-durable good demand. But keep in mind, the supply chains were not any bigger than they were pre-pandemic, and largely probably were actually more disrupted because the pandemic itself was disrupting the supply chains for goods. In fact, many of the goods that we wanted to buy here in this country come from overseas and from places like China. And of course, those were being disrupted by the pandemic as well. So this surge in goods-based demand during the pandemic hit up against supply chain disruptions. Not even if the supply chain wasn't disrupted, it may not have been able to handle this big surge in demand. And the result of that was inflation. Now, we've sort of worked out a lot of the supply chain elements. There's still issues with, say, China being in large lockdowns in many cities still. You better go out and buy your iPhone 14 now because there may not be that many come Christmas time, if that's on your Christmas list. But largely speaking, the manufacturing and the goods sectors of the economy have sort of ironed things out, and inflation is actually coming down in those areas, even though we still have very high levels of demand relative or consumption relative to pre-pandemic levels, 20 to 25% more than then. But the service sector, while it did rebound modestly, about half recovered from 80 back to 90 of when we reopened during the pandemic, you can see it was a very slow and long recovery for that last 10%. In fact, only just recently at the beginning of this year did we get to above COVID levels of service sector consumption. Now that's largely us realizing, yes, we want to go to the movies and see that new film, or go out and eat in restaurants, or travel and stay in hotels and take airline flights. All of those things, all of that demand has showed up. But now look at where we are in August or September of this year. The consumption spending in the United States is higher than it was pre-pandemic for all three sectors. There's a lot of consumption demand in our economy today. And that's really what's causing this inflationary push across our sector, is when the ability to meet that demand with supply. We don't necessarily have a lot more supply capability in the goods side, and on the service side, a constrained labor supply, which is the primary input to supply services, that's coming against a strong amount of demand, and hence inflation is occurring. But we first have to ask the question, where or why is all that consumption coming from? And we can look at savings rates for this. This is the savings rate, not the stock of savings in your bank account, but how much of your income one saves at each point in time. And we were running at about a just under 10% savings rate. That's close to our historic average as a country, lower than many others, but historic for us prior to the pandemic. But when the pandemic hit, you can see that yellow line spike. That's the first round of fiscal stimulus. And the second spikes in 2021, that's the second rounds of fiscal stimulus. So lots of money put into consumers' hands and put by those consumers into bank accounts. We have trillions of dollars of excess savings today sitting in individuals' bank accounts in this country. Now that yellow line is now well below trend for the savings rate, and that's because of all those excess savings. Why keep saving at a rate of 8 or 9% when I have built up this sort of big nest egg of savings in my account, which is now being whittled down to continue to pay for those consumption of services and goods, to sort of keep that consumer spending high, even in the face of higher interest rates. This is kind of like a standoff, Western style, between Jerome Powell and the Fed and the American consumer. And the Fed's like, I'm going to keep raising rates until you stop spending. The consumer's laughing at them and saying, well, we'll just keep taking money out of our savings account that you gave us a few years ago. Well, not Jerome, but the federal side of the government gave them, and we'll keep spending that and keep consumption high. And so consumption's not really wiggling, even though eventually, presumably, we work through all of those savings and really have to curtail consumption, or the Fed keeps raising rates. We'll talk about that a little bit later. keeps raising rates, and that actually does sort of begin to change our response. But right now, generally speaking, consumption has softened a little bit, but not very much considering how much monetary policy tightening has occurred. And that's in large part because of all of this excess savings that we have today in our economy. But let's focus a little bit more on the service side of the economy, because that's where the action really is today. Goods really beginning to fix themselves, supply chains correcting, although the China thing is new for this Christmas. But generally speaking, the focus is on the service side. Demand has surged on the service side, and employers cannot find enough workers. The blue line here is people being hired. We hire about 6 million every period. Relative to openings, you can see there's relative balance to openings, and hires generally stay pretty close to each other, so the labor market is in relative balance between, you can think of the green line of openings as demand for labor and hires as the matched supply of labor. This is indicating a big supply and demand mismatch in the labor market to the tune of almost 2 jobs open per person being hired, which is historically extremely high. This is most vociferously being found in the service sector, and there are really 2 reasons why this is happening. The first is we're still short workers. The participation rate is still down by historic norms, and the reasons why people are not participating in the labor force are still COVID related. This is the number of adults aged 25 to 54. We call it prime aged, working aged adults. And this is based upon a survey where we asked, well, why were you not participating in the workforce in the last few weeks? And the 2 most important things to note are the blue and the green lines here, which are somehow related to something to do with coronavirus, whether you have it, someone you know has it, or you're afraid of getting it, or caring for children not in school or daycare, which honestly is related to that aspect of if the child is home because they have COVID, then you're home because you're caring for them, all of those dynamics. But caring for a child is 4 million people stay out of the workforce to deal with that on any given day at the moment. And that's lower than it was earlier in the pandemic, but still a big chunk of people. And about 2 million people still stay out of the workforce because of fear of or having COVID. So about 6 million people don't show up for work, if you will, still because of the long run effects of COVID. We've gotten used to and live with coronavirus. That's all very good, but there is a consistent and long run impact still happening every day in our economy that is keeping millions of workers sidelined and not participating in the workforce. And keep in mind that the service sector, which is so short on labor right now, is in large part where many of these people were working before, aren't working anymore, and aren't coming back to work as well. So this is exacerbating the supply of labor shortage, particularly in the service sector today. Well, no surprise, you can see that plays out in higher wages. In fact, the service sector wage growth rate is almost 8%, as opposed to the overall at 5%. Many other sectors of the economy, the wage growth rate has slowed to below 5%, and so that average is being pulled up largely by the service sector, where there's still very, very strong wage growth. And it's important to understand why this matters. First of all, predominantly in the service sector, if the wages are going up by 7, 8, or 8 or 9% on an annualized basis, and the service sector is a predominantly labor-driven good, your primary input in a restaurant is your labor, and so it's very easy to pass those costs of your inputs on in the form of a higher price of a restaurant meal, a higher price of a movie ticket, a higher price of a sporting arena event ticket. So that gets capitalized into the price, which then the consumer experiences as inflation. And when we look at the inflation numbers, the largest chunk of the most recent headline inflation is coming from shelter rents as well as the service sector economy. So there is a pass-through or a spiral, dare we say, between wages and price inflation that is occurring in the service sector today. Now, the Fed is very worried about this. Jerome Powell, in his last statement, said It's hard to know if a wage inflation spiral is occurring until you see it, and once you see it, it's too late. So he's saying, I'm going to try and avoid it at all costs. Now, we might say, well, we can clearly see a spiral here. Wages are higher, prices of restaurant meals are higher. Won't that keep going? Except for the fact that consumers are still expecting that prices will decline in the coming year to 2 years and get back to the more longer run 2 to 3% range. And as long as the expectation is there for lower prices in the future, I won't ask for that next wage increase, which won't create that self-fulfilling prophecy of a price increase. So that's really where the focus is. They're watching the service sector very closely right now and trying to make sure that we don't embed this expectation of what wages, rising prices, rising wages as a future expectation. If it does turn into that, then it's a much more challenging task for the Fed to get that under control. So this is really the place to watch. If you're interested in Fed watching over the next few months, look at what's going on in terms of wages and prices, particularly in the service sector of the economy, and expectations to see if we begin to bake in something like a wage inflation spiral. Not there yet. Let's talk a little bit more about the Fed. So the Fed has a dual mandate: keep unemployment low and keep prices stable. They've done an excellent job of keeping unemployment low with all the fiscal stimulus and monetary policy that the government provided through the pandemic. There was a spike and an increase in unemployment, but we've gotten that back to very historic low levels. And so they can sort of play the lever of price stability, which is obviously not there anymore, play the lever of trying to get price stability under control, and seemingly have no impact right now on the labor market and that other mandate. In fact, the estimates, according to the Fed, of the unemployment rate rising due to their monetary policy increases to maybe 4 to 4.5% next year. By any historic standard, that is still an astronomically low unemployment rate. So the labor market is basically holding up really well to the monetary policy tightening that is occurring. And maybe that's because consumers are still spending, and so the demand for labor is still there for the near future. And so there's more room that they can give on really focusing on the price stability aspect, which, you know, they missed the mark. And I think they would agree that they missed the mark. We are sort of behind somewhat of an 8 ball here. Inflation is well beyond where it should be or where it's desired to be for stability purposes. And we are going to have to raise rates to get there. The question becomes, how far do we have to raise rates? Are we done at 4 where we are now? Will there be more rate increases next year? How many more? And will it go into 2024? There's a concept called the terminal rate. It was estimated to be around a Fed funds rate of about 4.6. It's now moved a little bit higher to about 5. That is where they need to ultimately get the federal funds rate to sort of get inflation back under control. So if we take it, it's hard to measure. It's actually theoretical. It's not really measurable at all. But let's say if 5 is the right number as our target, we're about a percentage point away. It's pretty clear, given the good read on the on less inflation year over year than expected, still high but less than expected growth in inflation that just came out this morning, that the Fed will ease up and only do, say, a 50 basis point increase in the federal funds rate in the mid-December meeting. And then likely, yes, more increases early next year, but of potentially also 50 or even smaller 25 basis point increases. We only have to get another % in total, roughly, maybe 5 or 5.25 by the middle of next year. And then sort of if the tea leaves are right, then there's a suggestion is that we would be sort of done with rate increases at that point. That said, over the next 6 to 9 months, that does put some upward pressure, further upward pressure on mortgage rates, even towards 8. It is interesting to note, though, even today, the mortgage rate has floated back to 6 2/3 from 7 1/4 in just a day, because the CPI read came in and people are saying, oh, that is better than expected. Treasury yields have now gone down. They're now more like 3.9 or 3.8 and change, below the 4% mark for a 10-year yield, and mortgage rates have come down a little bit. So we move around a lot. In a sort of relatively narrow range of 50 to 75 basis points, but a 50 to 60 basis point jump in one day down is sort of relative good news and an indication of, we're getting towards seeing the end in sight with regard to interest rates and mortgage rates as well. I'll give you one other piece of good news when it comes, because what I just said wasn't necessarily much good news, when it comes to mortgage rates and inflation and interest rates in general here in the US. And that is that the long run rate should probably be low and significantly lower than where it is now. We're only having to increase rates at the moment to fight down that or tame that inflation that we see today. The long-term neutral rate of interest is represented on the orange line is barely 1% right now. Well, what is that? That is essentially that plus inflation, so 2 plus this is 3, is the target long run rate for the federal funds rate. So we're well above that for good reason at the moment. But the dynamics that have caused that long run neutral rate to be so low are still in play and will be in play for many years to come. Why is that? Well, the price of money, this long-term rate, is influenced by the amount of money looking for investment in the globe. And luckily for us, there's excess savings throughout the globe today in places like China and Western Europe, aging societies. The older you get, the more you save. So globally, the populations are aging and there's more and more savings because of that. All of that savings is looking for places to go and invest for its, modest returns. Well, there aren't a lot of good places to go and invest your money around the world today, other than the United States. So arguably the prettiest horse in the glue factory, one might say. And hey, I'll take that at this point in time. And that's meant an excess flow of savings through the capital markets coming to the United States, primarily invested in things like 10-year treasury bonds. This is why our treasuries have remain so low and stay low, even now, very close to, or at some points even inverted relative to shorter term yields and inverted relative to the Fed funds rate. It's because all the savings is coming in and investing in the safe assets of this economy. Real estate is actually another one that benefits from all of that savings glut. So savings glut shows up here, presses rates down. Additionally, on the demand side, in addition to 10-year bonds, if you were going to invest in real estate or other assets, our ability to spend those dollars for capital investment is much more productive than it was, say, 30 years ago. A dollar invested in increasing manufacturing capacity 30 years ago got you, $1.5 of return. A dollar invested today gets you $2 and $3 or more dollars of return because it's largely invested in software and technology, where if you make a better mousetrap, you can sell that marginal web click or that marginal ad for next to nothing. And so because we've shifted to a technology service-based economy, our productivity over capital investment dollars has increased, and therefore we don't necessarily need as much of them. So those two dynamics keep down long-term rates. This means that once we get inflation tamed, the odds are that we will scale back again on the Fed's funds rates, and we will draw down the mortgage rate yet again. Will we ever get back to the 2 3/4 that we've seen in the pandemic? Yeah, well, maybe if there's another pandemic, but I don't think we want that. So maybe we'll never get there, but certainly we're not going to stay in the 6 to 7 or even 8% range for mortgage rates indefinitely. They will come back down again once we get inflation tamed. Of course, it's hard to say exactly how long that will take. Okay, so that's the economy. Let's talk about the impact on the housing market. And the first thing that clearly we want to note is affordability. What do we mean by affordability? Well, it's really driven by interest rates and the dynamics of the market that have occurred because of falling interest rates. 1981, inflation rate was 18%. Pretty much since then, in the long run, rates have come down. That has meant you buy your home, 3 years later, you refinance, it costs you less to refinance the same amount of money. 3 or 4 years later than that, because typically people lived in their homes for 7 years, you sell your home, you buy another one. And even if you haven't gained any income or any equity, you could still buy more home because the interest rate is lower. So that turnover engine in the housing economy has persisted for the last 40 years in our economy. Changes now, though. That spike in interest rates and mortgage rates in particular that you see on the right-hand side of this chart, very, very steep, very sudden, that shuts down a couple of things. First of all of those existing homeowners say, right, well, I have a 3% mortgage rates are now 7%. Even to buy my proverbial own home back for myself is going to cost me a lot more per month. Not going to do it. Neither do they supply inventory for sale, nor do they buy a home. So that's a lost sale. There's a big pressure there being caused by higher rates right now. 85% of all mortgages are under 6% at the moment, so all out of the money. But more importantly, if we focus less on the existing homeowner, because the existing homeowner doesn't really have an affordability issue. They've already achieved the challenge of becoming a homeowner. They're an existing homeowner. They also have the benefit of the largest chunk usually of their household budget, which is their mortgage payment, is with a 30-year fixed rate loan. So all this inflation that's happened has done nothing to change that component of their household budget. It's one of the best inflation hedges that you have out there. 50% of my budget is not inflating because I have a 30-year fixed rate loan. Interestingly, we are unique in this country because most other major Western economies have floating and balloon mortgages that force people back out into the market rate. So places like Australia, Canada, New Zealand, England, they are facing much more repricing in the housing market because they don't have this 30-year fixed rate instrument, which really helps insulate large numbers of households. But who we are concerned about from an affordability perspective is the potential first-time home buyer, because they don't own a home. They don't get the benefit of the asset. If they're trying to buy a home today versus 6 months ago, they've lost about 40% of their purchasing power just because rates have moved so quickly higher. And so you used to be able to afford to buy a home of $600,000 just because rates have gone up. You're probably now only be able to afford, meaning the same monthly payment, a $500,000 home. That blue line is showing the big decline in relative affordability due to increasing interest rates. Well, your wages have gone up, so that mutes things a little bit. And now, because of this big curtailment of demand due to affordability constraints amongst those potential first-time home buyers, prices are correcting. And so not that you will get all of your lost affordability back, but if prices are lower today than they were 6 months ago and your affordability to what you can afford to buy has gone down, you might be able to buy, that home's coming to meet you, if you will, to some extent, maybe not entirely, but that will be a benefit as house prices correct over time. So we'll begin to see some stabilization, I think, in affordability. One is rates don't move too much more or only moderately higher, but more so because incomes will continue to grow and house prices, as measured in that green line, will tip over and actually, well, we already see it decline in some markets. So let's talk about house prices. Here we're showing the top 50 metros that we track. The blue line is the annualized pace of appreciation at the peak appreciation rate, which for most markets was early this year or late last. You can see that there were many blue lines, many markets here with appreciation rates well above 20%. For context, the long run average appreciation rate is 3.6% per year. So we had many markets going at many multiples of the long run average. The green bars are August of 2022. That's our most recent index measure. And you can see the year-over-year rates are much smaller. In fact, Sacramento has gone from a run rate of almost 25% to barely 5%. Phoenix from almost 35% annualized appreciation at the peak to just 15% now. So the paces of appreciation are cooling significantly. The only way that can happen is that we have to observe actual price declines. The best analogy to think about it here is we went into the beginning of the year and gained in many markets 10, 15% in just the first 3, 4, 5 months of the year. So you go up one side of the roller coaster. We peak at the top and we start coming down the other side. A year-over-year measure is always going to sort of draw the horizontal line across. So we are declining in prices. San Francisco is down 6% from peak. But because you went up one side so much, we haven't gone all the way down. We might end the year in many markets at 0 or even 5 or 6 annualized appreciation, that on net over the course of the year, you're still up relative to the beginning of the year. Roller coaster analogy. Going into next year, we might continue to go down, sort of keep going down that roller coaster, and probably there may be some markets that ultimately go below where we started, so to speak, at the beginning of the year. In other words, the roller coaster dips at the bottom lower than where you started the run up on the one side. But there will be many markets that may not, or may eke out no net loss altogether. And the challenge here is that for most of those homeowners, it's no loss at all. You buy your home in 2019, if you bought your home in the US in the early 2020s at the beginning of pandemic, the average nationwide total amount of appreciation to today was 27%. We would have to have losses of prices of 27% to wipe away the gains made over the pandemic. Who is at risk? Well, the individual who bought the home at the peak. Clearly, they're going underwater or eating away at their hard-earned equity that they used as a down payment. But that's not most people in the housing market writ large. So keep in mind these dynamics of prices. We are seeing price corrections, prices coming down, but that doesn't necessarily mean big overall losses or annualized losses when you compare it to the fact that we've had so much strong growth even in the beginning of this year. Okay, but for the renter, it's still an issue. We want to ask, well, how much homes are actually affordable for sale? Their affordability is being curtailed by interest rate increases, possibly benefited by beginnings of price declines. But we want to ask the question, for the median renter in each market and their income in that market and the prevailing interest rate, how many homes could they afford to buy? You can see on the left-hand side of the axis the share of affordable homes. There are some markets with lots of homes that are affordable. Pittsburgh, Buffalo, Oklahoma City, Cincinnati. I see a theme of cold showing up there. That's why we made the blue. And then at the other end of the axis, the green ones, there are a number of markets, most of them in California, with very, very small shares of homes affordable for the median renters in those markets. And that's really the way to think about the affordability challenge, not for the existing owner. They should stay put or will stay put, but for that potential first-time home buyer who is currently a renter living in that market, how much can they afford to buy? And there are markets even today, and this was true prior to the pandemic as well, with significant dearths of affordable housing stock for that median individual. Now, that's not to say the above median individual obviously can afford to buy more, but it also means that the below median individual renter is even worse off than what we're showing in this chart. So we have affordability challenges writ large and long run in our housing market and mortgage finance system today. Okay, so let's talk about, you can't buy what's not for sale. We talked about the dynamics of the first-time home buyer, their ability to afford something, but that says nothing about, even if I could afford to buy a home, if there's nothing to buy, that really doesn't help me. It's essentially the same thing as not becoming a homeowner. Looking long run here at sales, existing home sales have been running along at a rate of somewhere around 3 to 4 million a year in the early 1990s, up to as high as 7 prior to the global financial crisis, which was way too high and not fundamentally supported. Crashed back to 4. Rebounded into the last decade of somewhere in the mid 5s, and then spiked above 6, as high as 6.7 during the pandemic. And now we've come off dramatically, about 40% down from the peak in terms of home sales to about 4.5 or 4.6. But in the historical context, 4.6 is a lot less than 6.7, but we should never really have been there. In fact, probably the long run fundamentally supported level is only about 5.5 or 5.6 million home sales. So even though we're down and below that long run trend, we're not that much down relative to the over exuberant level that we were in the pandemic. So that sort of gives us that little bit more level of context. I know it's painful, but 6 is too much right now. You know, what's just right Goldilocks style? Probably the mid 5s. Now, part of what will help us here and what's constraining the market, even the amount of sales in the market, and will draw sales further down, isn't the potential buyers, it's the inventory. You can't have a sale if there's nothing for sale. And the green line shows the inventory of homes for sale, which is also by any historic standard. Clearly, that green line is much lower, measured on the right-hand axis, much lower than it has historically ever been. We had a lot of inventory prior to the global financial crisis. That was actually a lot of turnover of home sales rather than intrinsic inventory. Now we have record lows. But I think a better way to show inventory is actually with the orange line on the right-hand axis, because over time, we would expect there to be more inventory at any point in time, more close to now than in the past, simply because the housing market has grown, or the stock of housing has grown dramatically over the last 30 years. The size of the number of households requiring shelter in the United States in 1991 is not nearly the same as it is now. And so the sheer size of the stock of housing, meaning how much of it might be for sale at any point in time, has significantly increased. So we don't look at counts so much as the percentage of stock, and that's the orange line. And you can see at the peak, 4% of the stock of homes were being sold at any point in time. That was up from probably a more longer run average of somewhere around 2.5 if you cut the difference prior to the boom. But now we're barely at 1. It's true that inventory has increased, and it has increased a lot relative to where we were a year ago. But adding a lot to zero is still close to zero. And so what's happening here is there has been an improvement in inventory, yes, but it's still not nearly enough by any standard. Well, what's driving that? First of all, those existing homeowners are all deciding to stay put. Rate locked in, not going to sell my home, not going to buy a home, not going to participate in the market. And we see that new inventory inbound is actually even lower than it was last year, and it was astronomically low last year. So no new listings coming on. But the stock that was out and available for sale has sort of gotten caught by the turn in the market, because demand has curtailed due to affordability constraints dramatically amongst those potential first-time home buyers. There's no existing homeowners participating, so that is the market, and the stock is sitting there longer. So what used to sell in 3 days, 2 days, 2 hours, now takes 17 days to sell, which is, by the way, still pretty darn fast by any historic standard. But while there is more inventory than there was a year ago, there is still surely not enough for a long-run healthy market in the United States. That also, by the way, will help keep pressure up on prices and not have big price collapses. Well, if we can't find it in the existing market, maybe we can find it in the new. The problem is the home builders can't get the homes to market at the moment. You can see the green line is basically under construction. It's a very, very high level. There's a ton of inventory essentially in the new market, but none of it is yet livable. It's not delivered yet. It's not completed. That's in large part due to supply constraints on inputs that were windows and appliances in the past, but is now on labor. And now increasingly, the other issue is that if I'm a home builder, that blue line is sort of the not started line. I'm questioning whether to start building new homes at this point, because why would I do that with all the uncertainty? I may or may not be able to deliver that home in 9 months or 12 months. I have no idea what the interest rate environment is going to look like then. I have no idea how much price concessions I'm going to have to give 12 months from now. All of that uncertainty is causing home builders to stop building or starting new construction. That said, there's a fair amount in the pipe that they will complete eventually that will come to market, but this is only about 10% of the total market, so it's not a panacea by any stretch. And keep in mind that potential first-time home buyer, that entry-level buyer, is not who the home builders build for. Most of these new homes are much more expensive than one that an entry-level buyer would buy. And so we have that dynamic of even the new home market, who has traditionally sort of served the move-up buyer, that existing homeowner who had a lower mortgage rate because of the long-run decline, who's not there anymore. That's who they traditionally serve, not the potential first-time home buyer. In fact, they're staying put in the home that they would have made available to that potential first-time home buyer. We call this process up-filtering, and up-filtering is not happening to the degree that it historically done over the last 30 years, and that is one long-run impact that we will see from higher rate or rising rate environments. Okay, so Affordability housing market. Also, let's talk about something a little bit more positive, why this is not 2008. If we fear that this is going to be a crash like then, I say no, it won't. And here's my argument why. Yes, we know we probably haven't found the bottom for existing home sales. Mortgage applications, leading indicator by about 3 months. They've trended lower. You can see from this line, that green line's probably going to follow further down to below 4.5 million or towards 4. We're going to plumb a bottom of home sales somewhere in the 4 to 4.5 range, most likely early next year and in the spring. But why won't we have a sheer collapse other than in the volume of sales? Well, sorry, before we go there, refinances down and gone. No one's refinancing. 85% of all mortgages are out of the money by at least 1% and 50 or more percent by 3-4 percentage points, right? So there's really no incentive to refinance anymore. But some good news. We've maintained credit quality. The strength of people who bought homes or refinanced homes over the last 10 years is much better than prior to the global financial crisis. So if there is distress, the odds that it turns into defaults for our existing stock of mortgages is lower because the credit quality is higher. And in fact, in the pandemic, we took the credit quality even higher. It is fading back again because all that uncertainty, you had to make sure that those borrowers were going to be able to pay if you were going to give them a loan in 2021 or really 2020 and 2021. So credit quality has maintained a very strong standard. Now that might have priced some people out of the market from a credit quality perspective, but those who were able to get mortgages, it certainly means that the risk of default and delinquency is lower for this single fact alone, because the quality of the borrowers to sustain an income shock is better than when there were more with lower credit scores in the portfolio. Another reason is the burden of paying those mortgage payments is much lower. Typically, the old adage was about half of your income to mortgage. That's a third of your income to mortgage, which is half of your after taxes. That's actually much lower now. It's barely 30% because interest rates are so low. So the amount or the share of your household budget that you spend on your mortgage is at all-time historic lows, or at least as long as we've been able to track the data for the last 40 years. The burden is lower. That means if you were to get into a situation where you have an income shock, a partial income shock, maybe you can still figure out how to make that mortgage payment and not go into delinquency. Again, less debt burdened households, more able to weather income shocks, say like an unemployment spell if there's a recession, and therefore not transitioning into mortgage delinquencies and credit delinquencies, and therefore the risk of foreclosure. So that risk is muted because of low mortgage debt burdens. The other really big one here is the amount of equity. $30 trillion of equity held by homeowners today in the United States. That's significantly higher than it was in the global financial crisis. In fact, we calculate a national LTV. That national LTV was as high as over 50%, the blue bars. In the global financial crisis, it's barely 30% now. Homeowners have large amounts of equity. The number, and it's really not necessarily about equity, is whether or not you are underwater. And we estimate that about 1.5% of all households today are underwater. That is significantly up from a year ago at 0.75%. But let's keep in mind, whether it's 0.75 or 1.5, it's still a very, very low share of households who are actually in an underwater position. The reason we worry about these things is the foreclosure risk. And foreclosure is something that requires two or dual triggers. First, the income distress event has to occur, and at the same time, having no equity, being underwater, has to occur. If you have equity in your home and you can't make your mortgage payment, you sell your home, you walk away with you pay off the loan, you walk away with your equity. If, on the other hand, you don't have equity in your home, but you're keeping to making your mortgage payments, you can continue to do that. You don't go into foreclosure either. The global financial crisis was unique in that both of those triggers happened at the same time. You can see green line, the amount of equity was declining. People were getting underwater. They didn't have any equity in their homes. At the same time, people were losing their jobs. The unemployment rate was going up. The dual triggers came together. We had lots of foreclosures. But if you fast forward to today, equity at record levels, unemployment rates at record lows, And even if, as we expect, the unemployment rate to rise modestly, and as we expect house prices to decline modestly, these things begin to contract a little bit, it would take significantly more than what is expected to actually create the scenario like we had in the global financial crisis. So it's highly unlikely that we will see a foreclosure tsunami, more like a trickle. There will be more foreclosures than there have been in recent years, but certainly not to the extent, and even maybe not even up to the long run average rates of foreclosures in our market. So foreclosure risk is still very low. One last thing I'll point out when it comes to house prices. It's not necessarily the case that when rates rise, house prices fall. In fact, these are all time periods of rising rate regimes. And in all of them, house prices went up, not down. Now, we are experiencing one today where rising rates is, in fact, helping to curtail affordability and reduce house prices. But to say that it is always the case is far from the truth. In fact, the last time house prices went down isn't even on this chart because mortgage rates were also going down at the time of the global financial crisis. The Fed was trying to shore up the situation. So there is no real strong correlation between rising rates and house price depreciation. An important point to note. It's much more complicated combination of events that causes prices to decline, like where we are today, which is, yes, rising rates curtailing affordability, but also basically the fact that we had a lot of excess house price appreciation due to the supply and demand imbalance. And with that, Kristen, I'll put a shameless plug in for my Reconomy podcast. You can find it on any platform that you listen to your podcasts on, typically 9 to 12 minutes every 2 weeks. So an easy listen, hopefully you would enjoy. We talk about many of the things I just talked about here. We will keep you updated on the podcast with many of these items, and we do it in a hopefully fun and lighthearted way. And here are the other ways that you can reach us at First American. Thank you. And Kristen, let's go to questions.
Thank you so much for that wealth of knowledge, Mark. We have quite a few questions that have come in. I will start with very early on in the presentation. Could supply expansion help the inflation issue rather than just pounding down demand by increasing rates?
The supply, I'll assume from the question he means this is supply expansion of goods writ large. Good. Yes, right. If it's early in the presentation, yes, certainly. The more we can get supply to meet the demand, price inflation can be muted. You're absolutely right. Inflation can be caused by either too much demand relative to supply or too little supply relative to demand. You can do either side to fix the problem. And that is definitely happening in the manufacturing and goods sectors as we speak.
Quite a few people have asked a question similar to this. What are your thoughts on the tech layoffs and how that's going to impact real estate prices, or if it will?
So, well, the impact on real estate prices, I think that's a local market matter, right? Where those technology employees are concentrated, obviously you're having one of those income shock events that I was just talking about is happening to those markets. And so that creates less demand. You're not going to go out and buy a home if you fear or have lost your job in the tech sector. And also potentially if you are a homeowner and you've lost that income, although many of those people are high credit quality, that creates that possibility. But that said, we're talking about where is tech concentrated? Austin, San Francisco Bay Area. These are places where these people have plenty of equity in their homes.
Any thoughts on how the pandemic will continue to affect the future economy?
So I think what I was alluding to with participation in the labor force, I think that's going to be a longer, persistent element of for a challenge for the economy, which is, people just not showing up to work, so to speak. That means not necessarily having a job, but a willingness or an ability to work while we still work through the pandemic for a number of years to come. The prime age labor force participation rate is still a couple of percentage points low. What that means for the economy, though, is if you really boil it down simply, we grow the amount of output. GDP is the dollarized value of the amount of total output we create. through either adding more workers, basically growing the labor force and having them do more work per hour, and or increase the amount of output per worker per hour. The productivity rate's about 1.5%. It really hasn't moved very much at all. So one of the key ways in which to grow the economy and get GDP growth is to expand the labor force. And so the challenge is getting through COVID and getting people participating in work is an extremely important aspect to actually getting ultimate economic growth.
Is there any forecast as to how long that impact will last?
No, I mean, that's asking for forecasts for how long COVID will keep, surging and rebounding. And I don't think anybody knows the answer to that. Far be it. I mean, I like to play epidemiologist, but generally not good at it.
We'll leave it up to the economics to you.
Yeah, exactly.
I thought this was an interesting question. What is the definition of affordable housing when you describe affordable housing?
Yeah, there's a lot of definitions out there. The standard one is typically something like, what could the low and moderate incomed individual, and that's usually measured as sort of I think it's the 30th to 50th percentile income person afford to buy, would be defined as affordable housing. There are lots of other ways to slice it. The general truth is, by whatever measure you have, there's really not that much of it. We have historically provided affordable housing, not by basically making cheap housing units, but by what's called another filtering process, which is homes get built, their new homes are pricey, then they get old. We call them existing, but they're really used, right? Used homes. And the more used and old a home becomes, the less pricey it becomes. And so it sort of filters down and people move in and out in the income distribution. But as a home gets older and less expensive, it becomes affordable. And then ultimately it's too dilapidated. We knock it down and we put a new home up and the whole process begins again. That sort of process of down filtering of the housing stock is actually breaking right now. Because instead of it filtering down in, say, a low-income neighborhood, gentrification is coming in and filtering it back up before it makes it into that affordable category. And so we have a challenge of the definition of affordable, however you slice it, we don't have enough of it by any stretch of the imagination in the housing stock today.
Thank you. You were talking about your mortgage being 30% of your income. Is that true for people who purchased in the last 2 years with higher prices or just overall?
It still actually remains true. What happened, even though prices were high because interest rates were low. And so your monthly payment to get that really expensive home wasn't necessarily that much more. In fact, the credit underwriting standards really kept a lid on sort of the debt to income ratio and didn't really allow what happened in the global financial crisis, which was much higher or basically non-documented debt to income ratios. Those weren't allowed. And so, yeah, we've pretty much held the line that most borrowers have had, new ones have had relatively sustainable and low debt ratios. The challenge is actually more on those affordable existing homeowners, the low and moderate income individuals who are homeowners who see their costs rise, not from their mortgage payments, but from their other costs of housing, that it's becoming a burden for them to be able to make their mortgage payments and remain homeowners. That's actually been more the challenge.
Okay. What are the expectations for housing price changes for new construction?
Well, so first, to be clear, the new construction market takes rate increases more on the chin than even the existing housing market does. And so we've seen bigger price corrections in the new market than in the existing market already. We've seen big declines in demand, lots of cancellations. The new market is even more sensitive to fluctuations in rates, and they're certainly suffering that consequence. So yeah, prices are being repriced, but it doesn't, it depends on the builder and the market and where they started with the price. I mean, they still might be making a profit even though they've cut the price on a home. So, when it's the new builder, it's sort of the question is, well, are you still profitable? at those lower prices, even though you might be, like many, having to reprice to reflect the fact that your borrowers have to pay more for their mortgages today.
Mm-hmm. And are the cost of goods for new construction still up given the supply shortages?
Yes, they're not as high as they have been. Like lumber is down more now than it has been, but writ large, the cost of inputs are higher. And labor is a significant input cost in construction, and that's also experiencing significant wage gains. And so that input cost is also going up as well.
Okay. A lot of questions coming in about interest rate predictions. What do you see in the next year to 2 years? When are we predicting that they will stabilize?
So I alluded to, remember what I said at the outset, don't say when or by how much, and don't look surprised. So when we have this webinar a year from now, I'll be like shocked and horrified, right? But you know, I'm not going to necessarily specifically say, I don't have my own specific. I try and sort of gauge the consensus of many others, and consensus seems to indicate that somewhere in the middle of next year, the Fed will probably have hit that terminal rate and have seen significant improvements in inflation rates coming down in the first half of the year. And so, you know, again, another roller coaster. We're sort of going to hit that peak somewhere, I think, mid next year, and then begin to be looking down the other side and saying, well, how quickly might we begin to get back to that long run fundamental neutral target rate and actually reduce potentially mortgages going into 23 or 2024 and 25. We got another 6 months to 3/4 of a year, I think, to go.
Okay. Well, deep breath.
Deep breath. We can hang in there. We're almost there. Honestly, the hard part is largely done, right?
That's
going
good.
from 3 to 7.
Yep, that's good news. We are running short on time, so I'll finish up with the last question. How do we help those that are priced out of the market?
Sorry, say that again, Kristen. How do we help?
Those who are priced out of the market.
Those who are priced out of the market. Yes, this is a great question. We have a lack of supply. We have not been building enough supply of shelter for the last decade. We've had the millennial generation show up on the home ownership doorstep saying, I'd love to finally buy a home. I've decided I'm in my 30s now. Yes, I'm doing it later than everybody else, but nope, I want to be a homeowner. I don't think, Kristen, we could dissuade many of your friends from wanting to be homeowners too. That demand is there. We're just not building enough homes. And so what do we see? Lack of demand, lack of supply relative to demand of a scarce good, higher prices. Regardless of the interest rate environment, that's the long run dynamic that's at play in the housing market today. That's what's causing all these affordability concerns. The solution, build more homes, increase the housing stock. And that's a very challenging task to do because home building is largely, or so the ability to build homes is largely driven at the local level by zoning, regulations, and local governments. And it's convincing those local governments and the constituencies in those localities to be willing to accept higher density and more housing. That's ultimately how we solve this problem, but it's going to take a long time.
Okay. Well, thank you so much for your time today, Mark, and thank you everyone for joining us. I hope you felt that this was a beneficial use of your time, and we look forward to talking to you soon. Have a great day, everyone.
Thank you.